Today, we're unpacking a story that feels like it's straight out of a financial thriller. It's called The Great Repricing, and it's about a seismic shift happening right now in the software industry. We're going to look at how the very AI that was supposed to be a golden goose is now threatening the exact business models of the tech giants that build it. And to really get what's happening, we have to go back to one specific day, a day that sent absolute shockwaves through the tech world and triggered a $500 billion panic on the stock market. You're going to want to circle this date on your calendar, January 29th, 2026, because this is the day the software industry's legendary moat, that huge competitive advantage that protected its massive profits for decades. Well, this is the day it started to look more like a puddle. In just one single, brutal trading session, more than $500 billion in market value just vanished from the enterprise software sector. Now, this wasn't just a market dip, okay? This was Wall Street fundamentally rethinking the future of an entire industry. And the biggest titan in the room? It took the hardest fall. Microsoft alone lost around $400 billion. That's one of the worst single-day drops in stock market history for a company that, up until then, had been the most valuable in the world. And this wasn't just a Microsoft problem, not at all. The damage was everywhere. You can see it right here. Industry giants like ServiceNow, SAP, Salesforce, they were all in a total free fall. Investors were sending a crystal clear message of no confidence. So that brings us to the big question. Why the panic? The strangest part of this whole thing is that this crash happened right after these companies posted record-breaking earnings. So what on earth did Wall Street see that suddenly made all those profits look, worthless? Okay, so the panic really came from this massive paradox that was building right at the heart of the AI gold rush. This growing and frankly scary disconnect between who was spending the money and who was actually making it. It really became a tale of two different companies. You had the ones paying for the AI revolution, and then you had the ones that were getting paid for it. So on one side, you've got Microsoft spending an unbelievable amount on infrastructure. And on the other, you have NVIDIA, the company providing that infrastructure, just seeing absolutely explosive growth. Just look at these numbers. Microsoft's spending on AI infrastructure shot up to a record $37.5 billion in a single quarter. But at the exact same time, growth in its super important Azure cloud unit was actually slowing down. And that spooked investors big time. They all started asking, hey, where is the return on this colossal investment? And suddenly, Wall Street had this big aha moment. They realized the real value, the real money in the AI boom wasn't being captured by software companies like Microsoft. Nope. It was all flowing to the hardware companies like NVIDIA, the folks selling the picks and shovels in this new digital gold rush. And this whole infrastructure paradox, it put a giant spotlight on a fundamental flaw in the business model that made software as a service, or SaaS, so incredibly profitable for decades. For years, the model was brilliant. It was called per-seat pricing, and the value of software was tied directly to human headcount. The more employees a company had, the more software licenses or seats they had to buy. It made growth predictable, it made it profitable. It was a beautiful thing. But here's the thing. AI completely breaks that model. What happens when the software you're selling is so good that it actually eliminates the need for the very human users you're charging for? This quote just nails it. Charging per seat for a product that eliminates seats is a self-defeating strategy. The better your product gets, the faster you shrink your own revenue. It's a huge problem. And look, this self-defeating model, it isn't just a theory. A real-world case study from a fintech giant called Klarna became the smoking gun that proved this threat was very, very real. So let's talk about Klarna. They didn't just dip their toes in AI, they used it to perform radical surgery on their own company. First, they ditched their expensive Salesforce CRM, then they built their own AI tools in-house. And get this, they used that AI to do the work of 700 employees, which let them slash their workforce by 40% without losing any productivity. Wild! Klarna's move signaled a stark new reality to the entire market. It showed that the biggest customers might not just reduce their number of seats, they might leave the platform completely. They could just take their most valuable asset, their own data, and build their own AI solutions. So you have this existential crisis staring you in the face. How is the software industry supposed to adapt? Well, it's all about a massive, frantic pivot in how they price their products. The whole industry is basically re-engineering its pricing models on the fly. Instead of that old per-seat model, we're seeing all these new approaches pop up. You've got companies like Intercom moving to outcome-based pricing, charging you like 99 cents per customer problem solved. Others, like Salesforce, are trying out usage-based models, so you pay per AI conversation. And then there's this fascinating new idea, the digital worker seat, where you literally license an AI agent for a flat monthly fee, just like a human employee. The goal here is simple. Realign the price with reality. You're no longer just paying for access to a tool for your employees. Now, you're paying for the results that tool actually delivers. The price is being tied to the tangible value the AI creates, not the number of humans who happen to log in. So, what does this all mean for the future of what has been one of the world's most powerful and profitable industries? Well, it means the easy money, that predictable per-seat subscription revenue, is gone. It's being replaced by a future that might be a little more volatile, but is ultimately way more aligned with actual value. Software isn't dead, not by a long shot, but the golden age of SaaS, as we knew it, that's over. And all of this leaves us with one final, really provocative question that is going to define the next decade of technology. It's the question investors are wrestling with right now. If AI can not only use software, but can actually build the software itself, then what is the fundamental value of software in the first place?